Hello and welcome to this special series, Financial Experts Unplugged. Joining me today is Ashish Goel, well-known certified financial planner and the founder of Vista Wealth. We often tend to speak a lot about equity. Today, we're going to talk to Ashish about debt and the role that debt plays in our life. Thanks very much, Ashish. While we all understand debt because we all have bank accounts, but very few people perhaps understand the importance of it as part of your mutual fund portfolio.
Right.
How important is debt in my portfolio? Because large amount of conversation happens around equity and not so much around debt.
Well, thank you very much, Vivek. It's a pleasure to be here. So debt is a very important, aspect of anyone's portfolio. It is generally, perception is the mutual fund are seen as only equity investments, which is not right. And as advisor and 25 years into this industry, we have realized people who have also invested in debt and benefited from them are more likely to, increase their allocation to mutual funds and even in equity investments because they get the results which is very, very apparently visible. And they can also build the portfolio as per the needs because many a time when you invest in only equities, so when you have short-term needs, they cannot be fulfilled by them. So once you have a debt portfolio, so you can take out money from debt, also fulfill your short-term goals, which gives more satisfaction. That's the mutual funds. By using mutual fund, I have got more return than the banks, which is an alternative available, and I am also able to fulfill my short-term goals. So that's the very important aspect of debt mutual funds.
So Ashish, when I look at a typical household portfolio, we are familiar with a savings account, we are familiar with a FD.
Yes.
And a lot of money is parked in there. More than 1 lakh crore rupees is lying in, more than that is lying in an FD or in a savings bank account. How does a debt mutual fund compare with these two, a savings account or an FD? Do they beat them? Do they give better returns than them? How does that work?
Yeah, definitely they give much better return than these two, saving account and bank FD. So in mutual funds, debt mutual funds specifically, we enjoy very special benefit of indexation, which is applicable once we complete 3 years. That means once we complete 3 years in debt mutual funds, we get indexation benefit, which is basically we are giving the basically inflation adjusted return minus the inflation. So the tax efficiency which comes, which is much more than bank FD. So in bank FD, even if you do 1 year, 3 year or 5 year, it is taxable as per your income. Here the taxation reduces a lot.
What I hear you say, Ashish, is there are a lot of different types of debt mutual funds.
Yes.
So how do I as an investor go about choosing the correct debt fund for myself? Of course, needless to say, you should go to your advisor.
Yeah.
Let your advisor do the hard work for you.
Yes.
But again, if I were to educate myself and understand, which I think every investor should, even if you are going to an advisor.
Definitely.
How do I pick the right debt mutual fund?
So you talk about how many kind of, so let's say as per the SEBI category, there are 16
categories.
categories of debt mutual fund only. So that comes to your point, please. The first thing to identify any mutual fund or any investment object, first identify a good financial advisor, which is very, very important. As lightly said by, but it is a very heavy, very important thing is कि आपका सलाहकार कौन है ये बहुत ज़रूरी है, because दुर्योधन के सलाहकार जो थे वो शकुनी थे और श्री अर्जुन के सलाहकार जो है वो श्री कृष्ण है और everybody knows what happens to their families and what happened to the result, actually. तो सलाहकार बहुत important है. That so I owe to you कि it is very important to identify a good financial advisor first whom you can trust. Now I think in debt, the most important point in selecting any fund is your time horizon. The more clarity you have about what time horizon you're looking at, the decision will become much, much easier. There are other points also, but the time horizon is the most important thing. Let's say suppose you have a very short-term money, which could be, let's say, for 3 months, 6 months. Then we have a very specific, ultra short-term kind of a category you can go for. And if you have, let's say, money for 3 years plus, this money will be, let's say, suppose there is some marriage in, family, maybe you want to buy a car after 3 years, 3.5 years, or upgrade your house, whatever it is. If you have 3 years money, it should go in, let's say, maybe credit risk fund or maybe medium term fund or short term fund. But if you have 3 months money, you should go in, let's say, maybe liquid fund, or the time horizon is the most important thing. And then So if somebody is able to get the time horizon right and planning right, I think the 90% of job will be done. Then come the risk profile and the matching portfolio. But if this going to the layman investor, I think it is easier if the one is able to just give in one thing, which is time horizon. At what time horizon the person is looking at.
Recently, Ashish, there were a lot of concerns around some debt fund schemes. And the concerns were really that certain companies in which they had invested or bought their debt or papers or given loans to were in trouble. And of course, the media reported this quite extensively.
Yes.
Is that something that I should be concerned about as an investor if I've already invested in a debt fund? The first thinking which comes when you hear negative news is, let me pull out my money.
Yes.
What is your view on that?
So I want to give two very big statements. Debt can be even riskier than equity.
Okay.
Because in equity years, it is either 25% plus or it can be 10% minus. In debt, it is either 1 or 0.
Okay.
So it could be very risky. But having said that, I will say the second very bold statement, don't need to withdraw your money. Because we are in the right hands, our industry is performing very well. If you see the kind of debt, it's a ballpark figure, 13 to 14 lakh crore we are managing. And the problem area is not even, let's say, 10, 15,000, maybe 25,000. I am not the keen observer of knowing what exact amount is. But it was a very small amount, which is being, and over, if you look at a period of 20, 30 years for which we are managing, and the accident we have comes down to maybe 0.01, 0.02 or 0.05, which is negligible. But the concerns are very genuine and it should be looked into it. And it depends, in which funds you have invested or through which advisor you have invested.
So Ashish, is it more convenient when it comes to debt mutual funds for me to be able to withdraw or to invest and do it seamlessly online?
Yes, digital, online, everything is available for across the product segment and everything is available. But specifically, if somebody has a very short-term money, let's say we deal with some few exporters and they have a lot of payment coming in and that payment remains for them for some time and then it also gets invested back into the business. For them, let's say maybe they want to invest 10 lakhs, 50 lakhs, 1 crore for 15 days. Then they feel sometimes it is not, very friendly for them to give checks and take checks. So they like to operate digitally or through apps where they can just transfer excess money for some time. And whenever they want money, they want the freedom to digitally or they get the redemption automatically. With which we have, as a company, Vista also provide an app and many other AMCs have also given an app where they can do the redemption and investment automatically. Once the account is set up, online system is set up, they can invest sitting from their home offices, wherever they can do, and it is just a matter of few seconds. The investment is done and investment is also withdrawn. And up to certain limit, the amount can be credited to a bank account within few minutes. So that is one option. The other option of, I'm just adding to what is the advantage of debt in one's portfolio is typically the investor, mass affluent, which are looking for, they generally do all debt investment in banks and they come for to us in older days equity investments, and whenever the market fluctuates they see their portfolio moving up and down too much. Over a period of time, let's say last decade, as we have grown debt portfolio, we have seen the jitteriness of the investor also going down, because let's say if the portfolio was 2 crores or let's say 1 crore and the equity portion is only 30 lakhs, 40 lakhs. When the market moves, the overall portfolio because of debt remains more stable. And the moment in 1 crore, if there is a, let's say, downside of 2 lakh, 3 lakh, it doesn't, feel that much of pinch. If that 30 lakh goes down 2 lakhs, it sees a lot of pinches there. So it has helped us to make people realize the importance of debt, and it also brings a lot of stability to the portfolio, which is helping us to also allocate more money to the.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.